The world today appears calm on the surface. Cities function, markets open every morning, banks process transactions, and digital numbers flow quietly across screens. Most people move through their daily routines, believing that the financial system surrounding them is stable, durable, and permanent. Salaries arrive on time, credit cards work without interruption, savings accounts quietly accumulate small increments of interest. It all feels predictable, structured, and safe. But beneath this calm exterior, something profound is happening. A transformation is underway inside the global monetary system, and very few people fully understand its scale. For decades, governments and monetary authorities have relied on a powerful tool to sustain economic growth, prevent recessions, and stabilize financial markets. That tool is the creation of money. Not money produced through the slow accumulation of productivity, labor, or natural resources, but money created digitally, instantaneously, through policy decisions and financial mechanisms that operate far beyond the awareness of the average citizen. At first, these actions seemed harmless. When economies slowed down, new liquidity was introduced. When markets struggled, financial institutions were supported. When governments faced deficits, debt was issued and absorbed by the system. Each intervention was justified as necessary, temporary, and responsible. And in the short term, it often worked. Markets recovered, asset prices rose, confidence returned. The system continued moving forward. But every intervention carried a hidden cost. Each new wave of money creation expanded the supply of currency circulating in the global economy. Each expansion diluted the value of existing currency, and over time, the accumulation of these decisions began to reshape the entire foundation of the financial system. Money, which once represented a stable store of value, slowly became something different. It became fluid, expandable, and increasingly detached from the physical world. For generations, people trusted paper money because they believed it represented something real. They believed it represented economic productivity, national strength, and responsible governance. They believed it was anchored to a stable framework that ensured long-term reliability. But that framework has been changing. The modern financial system now operates on a level of complexity and scale that previous generations could never have imagined. Digital balances, sovereign debt markets, derivative instruments, and globalized banking networks form an interconnected structure so vast that its true magnitude is difficult to comprehend. Within this structure, enormous quantities of money move every day. Trillions of dollars shift between institutions. Governments finance massive spending programs. Central banks intervene to stabilize markets. Corporations borrow at unprecedented levels. Investors chase returns across continents. On the surface, it looks like economic activity, but much of it is something else entirely. It is the expansion of a financial architecture that depends heavily on the continuous creation of currency and credit. And this is where growth grid sees tension. Because when currency expands faster than the real economy that supports it, the value of that currency inevitably begins to erode. This erosion does not happen overnight. It unfolds slowly at first, almost invisibly. Prices rise gradually, costs increase incrementally. Small changes accumulate over years until the difference becomes undeniable. What once purchased a full basket of goods now buys less. What once secured financial stability now struggles to maintain purchasing power. Inflation is often described using numbers and percentages, but its true impact is deeply personal. It changes the way people live. It alters retirement plans, saving strategies, and economic expectations. It redistributes wealth quietly, from those who hold currency to those who hold assets. And this dynamic has been intensifying for years. The expansion of global debt has accelerated dramatically. Governments have accumulated obligations on a scale that would have seemed impossible only a generation ago. Public debt, corporate borrowing, and financial leverage have all grown simultaneously, creating a system dependent on continuous liquidity. In simple terms, the system must keep expanding to remain stable. If liquidity slows, markets feel pressure. If credit tightens, economies contract. If confidence weakens, Financial institutions become vulnerable. To prevent these outcomes, monetary authorities intervene. They lower interest rates. They purchase financial assets. They inject liquidity into markets. Each action stabilizes the system temporarily, but each action also deepens its dependence on intervention. Over time, this creates a delicate balance, a system that appears stable but relies heavily on constant support, a structure that functions smoothly only as long as confidence remains intact. And confidence is a fragile thing. It depends on belief, belief that currencies will maintain value, belief that financial institutions remain solvent, belief that governments can manage debt responsibly. When that belief begins to weaken even slightly, the consequences can spread quickly. History has shown this repeatedly. Periods of excessive debt, rapid currency expansion, and financial complexity have often ended in dramatic adjustments. Sometimes those adjustments unfold gradually through inflation and currency depreciation. Other times they arrive suddenly through financial crises that force rapid revaluation of assets. In every case, the underlying pattern remains the same. When confidence in paper systems weakens, people begin searching for stability elsewhere. They begin searching for assets that cannot be printed, assets that exist independently of policy decisions, assets that have endured across centuries of economic upheaval. This search for stability is not driven by speculation. It is driven by preservation. People want to protect what they have built. They want to ensure that the value they store today remains meaningful tomorrow. And throughout history, one category of assets has consistently served that purpose: tangible stores of wealth. Physical assets that cannot be created by decree. Assets that exist in limited supply and carry intrinsic value recognized across cultures and generations. These assets have played a unique role in human economic history. Long before digital banking systems and global currency networks existed, societies relied on forms of wealth that were universally trusted. They were portable, durable, and scarce. They could not be manufactured easily, and they could not be diluted by policy. Because of these qualities, they became the foundation of trust in commerce and trade. Even as modern financial systems evolved and paper currencies replaced metallic standards, these tangible assets never disappeared. They remained quietly in the background of the global economy, held by institutions, stored in vaults, accumulated by individuals who understood their historical role. During periods of stability, their importance often fades from public attention. But during periods of uncertainty, their relevance returns quickly. This is because they represent something the modern financial system increasingly struggles to provide: certainty. The tangible anchor in a world dominated by abstract financial instruments. Today, that certainty is becoming more valuable. The global economy faces a convergence of pressures unlike anything seen in recent decades. Debt levels are historically high. Currency creation continues expanding. Geopolitical tensions influence trade and resource flows. Financial markets operate with extraordinary levels of leverage. Each of these forces alone would introduce uncertainty. Together, they create a landscape where stability becomes increasingly fragile. Investors, institutions, and governments all recognize this dynamic, even if it is not always discussed openly. Behind the scenes, strategies are evolving, portfolios are shifting, reserves are being reconsidered. Because when financial systems enter periods of structural change, the reallocation of capital can become enormous. And this is where the coming transformation begins to take shape. Across the world, vast pools of capital are searching for safety. Pension funds managing retirement savings, institutional investors controlling massive portfolios, sovereign reserves designed to protect national wealth. When even a small percentage of these funds begins moving towards scarce assets, the impact can be dramatic. Because the supply of such assets is limited, they cannot expand at the same pace as digital currency. They cannot multiply instantly through financial engineering. They exist in finite quantities. This imbalance between expanding capital and limited supply creates powerful upward pressure. And when momentum begins, it often accelerates rapidly. Markets that remained quiet for years can suddenly awaken. Prices that move slowly can begin climbing with surprising speed. Public awareness grows. Demand increases. Confidence builds. What began as cautious repositioning becomes a global movement toward tangible value. This process does not require panic. It simply requires recognition. Recognition that the monetary environment has changed. Recognition that currency systems built on expansion eventually reach moments of reassessment. Recognition that preserving wealth sometimes requires stepping outside conventional financial structures. At this moment in history, that recognition is beginning to spread, not through dramatic announcements or sudden declarations, but through quiet decisions, strategic allocations, gradual accumulation. Each decision alone may appear small, but collectively they represent something enormous. A shift in how wealth is protected in a world where currency creation has reached unprecedented levels. And as the shift accelerates, the consequences will extend far beyond individual portfolios. They will influence global markets, economic policy, and the balance between paper wealth and tangible value. The transformation will not happen overnight, but it is already underway, and the forces driving it are only beginning to gather momentum. What happens next is where the story becomes truly extraordinary. The forces already building beneath the surface of the global financial system are not small temporary disturbances. They are structural shifts that will reshape how wealth is stored, protected, and valued for years to come. The calm that many people still see in markets today is deceptive. Beneath that calm lies an enormous buildup of financial pressure, a pressure created by decades of expanding debt, growing liquidity, and policies designed to postpone economic pain rather than resolve it. For a long time, the strategy seemed to work. When economies slowed, new liquidity entered the system. When markets fell, support arrived quickly. When credit tightened, policies shifted to loosen it again. Each intervention bought time. Each one extended the life of the system. But every extension also added another layer of imbalance. Today, those imbalances have reached historic levels. Debt exists everywhere. Government debt, corporate debt, consumer debt, and financial leverage embedded inside markets themselves. This mountain of obligations must be serviced, rolled over, and continuously supported by the financial system. Without constant liquidity, that structure begins to strain. This is why the next phase of the monetary cycle is already becoming clear. The system will not allow liquidity to disappear. Instead, liquidity will expand even further. Trillions more will enter the financial system. This expansion is growth grid logic, not speculation. It is the predictable outcome of the system's own design. Governments cannot allow debt markets to collapse because entire economies depend on them. Financial institutions cannot allow liquidity to vanish because markets require it to function. Pension systems, insurance structures, and retirement funds rely on stability that can only exist when the financial system continues operating smoothly. The easiest way to maintain that smooth operation is to increase liquidity whenever stress appears. And stress is appearing everywhere. Rising costs, slowing productivity growth, fragile supply chains, geopolitical competition, and growing fiscal deficits are placing enormous pressure on policymakers. In response, the same solution continues to emerge. Inject liquidity, expand balance sheets, and stabilize the system with newly created money. But every wave of liquidity has consequences. When large amounts of currency are created, they must go somewhere. Money never remains idle forever. It moves through the financial system, searching for opportunity, safety, and preservation of value. Sometimes it flows into stock markets, pushing valuations higher. Sometimes it flows into real estate, inflating property prices across cities and regions. Sometimes it flows into bonds, lowering yields and supporting government borrowing. But when confidence in paper systems begins to weaken, the direction of that capital can change dramatically. Instead of chasing returns alone, investors begin prioritizing protection. Protection from inflation, protection from currency dilution, protection from systemic instability. At that moment, capital begins searching for assets that cannot be diluted by policy. Assets that remain scarce regardless of how much currency is created. This is where the coming transformation becomes powerful. Because while currencies can be expanded almost instantly, certain assets cannot. They require time, effort, and physical extraction from the earth. Their supply grows slowly, often only a few percentage points per year. No policy decision can suddenly multiply their quantity. That scarcity becomes incredibly important when trillions of dollars begin moving through global markets. Imagine what happens when even a small portion of massive institutional capital begins shifting toward assets with extremely limited supply. The imbalance between available capital and available material becomes dramatic. Prices begin to move. At first, the movement may appear gradual, a steady climb rather than a sudden spike. But markets are rarely linear when powerful forces align. Momentum builds as more participants recognize what is happening. Early movements attract attention. Attention attracts capital. Capital accelerates the trend. Before long, what began as quiet repositioning becomes a global shift in investment strategy. This is particularly true for assets that already possess thousands of years of historical trust. Throughout human civilization, certain materials have consistently served as reliable stores of value. They have endured empires rising and falling, currencies appearing and disappearing, and financial systems evolving from coins to paper to digital records. These materials carry something unique: universal recognition. Across cultures, across generations, across continents, they are understood as wealth. They are not dependent on any single government, institution, or political structure. Their value does not originate from policy declarations or banking systems. Instead, their value comes from scarcity, durability, and historical trust. Because of this, they become magnets for capital during periods of uncertainty, and the coming years may represent one of the most powerful periods of uncertainty the modern financial system has experienced. Consider the scale of capital involved in global finance today. Pension funds alone manage enormous reserves designed to support future retirees. Sovereign reserves held by nations represent strategic financial buffers. Investment funds, insurance portfolios, endowments, and global banks all control massive pools of capital, seeking safety and stability. When these institutions begin reallocating even small percentages of their holdings, the effect on scarce assets can be enormous. A shift of just 1% of global capital into limited supply stores of value represents hundreds of billions of dollars. A shift of several percent represents trillions. And that capital must compete for a supply that cannot expand quickly. This imbalance creates extraordinary price pressure. It is not driven by hype or speculation. It is driven by mathematics. Limited supply combined with expanding demand inevitably leads to repricing. And that repricing can accelerate once markets recognize the structural shift underway. There is also a psychological dimension to this process. Markets are not purely mechanical systems driven by numbers. They are reflections of human behavior, confidence, and fear. When people begin to sense that the value of currency is changing, their behavior changes too. Saving strategies evolve. Investment choices shift. Demand patterns move away from abstract financial promises toward tangible security. At first, only a small group recognizes the trend, but markets communicate through price movements. Rising prices attract attention, and attention spreads awareness. Gradually, more participants enter the market. Retail investors begin following the movement. Financial media begins discussing the trend. Institutions that were initially hesitant begin reconsidering their allocations. Momentum builds. This momentum can become incredibly powerful because it feeds on itself. Rising prices validate the thesis that tangible stores of value are becoming more important. That validation attracts additional capital, which pushes prices higher. Still, this cycle continues until the market reaches a new equilibrium. But when trillions of dollars are involved, that equilibrium may exist at price levels far beyond what people currently imagine. The coming years may witness one of the most significant revaluations of tangible assets in modern financial history. Not because of speculation, but because of structural necessity. The financial system must absorb enormous amounts of liquidity. Capital must find places where value can be preserved. Investors must protect purchasing power in an environment where currency supply continues expanding. Scarce assets naturally become the destination for that capital. And among those assets, certain materials hold a unique position. They serve not only as investment vehicles, but as monetary anchors. For thousands of years, they have been associated with wealth preservation during periods of economic upheaval. When financial systems changed, they remained. When currencies weakened, they retained purchasing power. When markets panicked, they provided stability. Because of that history, they carry deep psychological trust. Investors may experiment with many financial instruments, but when uncertainty rises, they often return to what has proven reliable across centuries. That historical memory is powerful. It influences decisions even in a modern digital economy. Today, the conditions that historically drove investors toward tangible monetary assets are beginning to reappear. Expanding money supply, rising inflationary pressure, geopolitical uncertainty, fragile financial structures. These forces create an environment where traditional assumptions about currency stability become less certain. And when certainty fades, demand for tangible wealth increases. The coming trillions of dollars entering the financial system will amplify this process dramatically. Each wave of liquidity increases the amount of capital searching for protection. Each wave expands the gap between digital currency supply and physical asset supply. Eventually, the imbalance becomes impossible for markets to ignore. Prices begin moving faster. Supply tightens as long-term holders refuse to sell. New buyers compete for limited availability. Markets that once seemed quiet suddenly become extremely active. The repricing process accelerates. This is how major financial transformations often unfold. Not gradually forever, but slowly at first, and then rapidly once momentum arrives. For those observing carefully, the early signals are already visible. Currency expansion continues. Debt levels remain historically high. Institutional interest in tangible assets is growing quietly. The conditions that historically preceded major movements in stores of value are aligning again. And when those conditions align while trillions of dollars of liquidity enter the system, the result can be extraordinary. Wealth preservation strategies that once seemed conservative suddenly appear visionary. Assets that were once overlooked become central to global investment portfolios. The financial landscape changes. Those who understand the forces driving the shift recognize that it is not a temporary phenomenon. It is part of a broader rebalancing between paper wealth and tangible value. A rebalancing that occurs periodically throughout economic history, whenever currency systems expand faster than the real resources they represent. The world may be approaching one of those moments again. A moment when trillions of dollars begin moving through global markets, searching for security. A moment when scarce stores of value attract unprecedented demand. A moment when the quiet foundations of wealth preservation rise to the center of the financial stage. And when that moment fully arrives, the repricing of tangible monetary assets could be unlike anything seen in the modern era. The movement may begin quietly, but its destination could reshape the financial world. We are entering a period of history where the rules of money are changing again. Trillions of dollars will continue moving through the financial system, searching for stability in a world where currencies expand faster than real value. In that environment, the assets that cannot be printed, diluted, or engineered into existence become more important than ever before. Those who recognize the shift early will understand that this moment is not simply another market cycle. It is a structural transformation in how wealth is protected. The coming trillions will move, the markets will respond, and the world will witness a revaluation of tangible value that few people are prepared for. When that transformation unfolds, the difference between holding paper promises and holding real stores of wealth may determine who preserves their future and who watches it slowly erode.